Hi everyone, I'm Doug Alsdorf, and in this video I'd like to show you how to answer question 2 in the quiz for chapter 14. As always, go to the WordPress webpage, go to the quizzes. Let's scroll down to chapter 14 quiz and have a look at the question. So question number 2, we're going to need to use the investing formulas spreadsheet and we're going to need the taxes spreadsheet. So let's go download those two spreadsheets also from the WordPress webpage. Click on the spreadsheets link. Investing formula is in the chapter 2 section and the taxes spreadsheet is in the chapter 4 section. Let's open up both of those and then see what the question is. So the question deals with taxable and tax deferred accounts and which is better for you. We're going to find out the tax deferred account is much better. It's going to use the results from the previous question where person A has 1.93 million in their taxable account after having invested their entire lives, whereas person B has 2.778 million in their tax deferred account, which includes a 401k. And the reason why they have a whole lot more money is because of that tax deferred concept of how it's helping to grow their monies. They're both while they're both not investing the same amount, person B, because they're in their tax deferred account, can invest more. They are living off from the same after tax money. So it's not like person B is making a lot more money. They're making the same amount of money. It's just that person B, through their tax deferred accounts, can invest more because they're paying less taxes. So the question starts off with, let's assume that in their retirement, they're going to live on $97,000 in after-tax money. We're going to calculate what their actual tax amount is here in a minute, their pre-tax money. How much is this in today's formula? We're going to say that it's 35 years from now is when they're going to retire. So this would be people in their early 30s, maybe late 20s, something like that. So we're going to say 97,000 in after-tax monies, 2% for inflation over those 35 years. So let's see what that would be in today's money to, just kind of get a feel. It's kind of 97,000 sounds like a lot of money, but if we put it in today's dollars, we'll see how much that is. 2% and then minus 35. Okay, that's 48,500. That's about $4,000 per month in after-tax monies to pay for all of their expenses. Maybe that's doable, but it's not living large, but it's doable. So we see 48,500. Let's write that down. How much will each person withdraw in their first year of retirement in order to have 97,000? So we need to go to the taxes spreadsheet and calculate what their income would be in order to generate that 97,000 after tax. So person A, I say to enter their values into E6 and watch cell F25. So let's go to the taxes spreadsheet. We'll go to we'll make this bigger so it's easier to see. So we're gonna it's E20. Let's double check what it's not E26. It's E6. Sorry about that. E6 and F25. Okay, so we're gonna start with E6. Well, that's cell E4, so we zero that. Let's put a zero in there. And we want cell E6. We're going to, and so this is somebody living off their taxable account with long-term gains. And what we want to see is down here in cell F25, we want this cell to be $97,000. So let's go into here and just start off with $100,000 and just see what we get from there. Well, we're close. We're at 90,000. So we're going to have to withdraw a little bit more. Let's see here. How about 110,000? Let's see what that gets us. So it's a bit of iteration here. 97.9, maybe a little less than that. Let's call it 109, I'll bet is a good guess here. Yeah, there we go. So that's their after-tax money in a taxable account, but they have long-term gains taxes. Now the question also asks, and write down the 109,000. Now the question also asks us, well, how about that tax deferred account? Well, that's short-term gains, and we got to set that up to get 97,000 down there. So here in the short-term gains in cell E5, let's again try 100,000 just to see what that looks like. So we're at 82. We better go a lot bigger. Let's try 120,000. Okay, real close at 120,000. Let's try 121,000. And yeah, okay, so 121,000, write that down. And those should be choices that, yeah, it's this middle choice right there. Okay, so now how long will person A's investments last in their retirement, assuming a 2% increase in their annual withdrawal and assuming a 5% investment growth rate? And I tell you to use Formula 5 in the investing formula spreadsheet. So let's go to the investing formula spreadsheet. And we have to figure, and we're double checking person A had 100, it was 1.931 million. So they're going to start off with 1.931000 million. No, not 19 million. We always get a little off there. There we go. 5% growth rate. Their annual withdrawal is 109,000, and that's going to grow at 2%. And we want to fiddle with this number right here until this number changes from positive to negative. So let's start, let's say at 20. Okay, it's still positive at 20. Let's try 25. Still positive. Let's try 26, still positive, 27. Okay, so between 26 and 27 years is how long that 1.931 million will last, given these parameters that we see there. Then, so that should be an option down here. Yeah, between 26 and 27 years. And now we want to figure out person B. Now, person B has 2.778, so let's enter that in here, 2778000, and they were withdrawing 121,000. Well, they definitely get to last longer than 27 years. Let's try 35 years. They can keep going. How about 45 years? Well, less than that. Let's try 40 and 41. Okay, so between 40 and 41, at 40, this number was still positive, and then at 41 years, it turns negative. So this person with their tax deferred accounts, IRAs and 401ks, was able to accumulate 2.7, $2.8 million, live on 100, withdrawing 121,000 per year, growing at 2% a year. Their retirement lasts 41 years. That is absolutely remarkable. Let's write that down. Okay, now that we have those, let's scroll down for the answers in question 2, and we'll see that we wrote down 48,500. Person A was 109, person B was 121, 26 and 27, and 40 and 41 years. What's remarkable about this is how long those retirement monies will last, given both conditions here. We have somebody in a taxable account, somebody in a tax deferred account. They're living on the same after tax monies. To accumulate those monies for their retirement, they were living on the same income to accumulate that during 35 years. So we haven't made an advantage to the tax deferred person. We haven't given them an advantage by allowing them to have more income. No, the only difference between them is one was in a tax deferred account, therefore their taxes are lower during the 35 years of accumulation, and therefore they can invest more. This is absolutely remarkable, and yet another sign to us how important your 401k and tax deferred IRA accounts actually are to you. Hope this was helpful.